What is a major warning sign of a recession? When companies are filing misleading financial statements and reports, you know it's time to pay close attention. Hi, my name is Chris Kovalchuk, and I'm an Associate Portfolio Manager at Claret Asset Management. Today, I want to talk to you about an interesting correlation between corporate dishonesty and economic recessions. It's true. Leading up to a recession, companies file more misleading reports. In fact, according to a recent study by researchers at the University of Missouri and Indiana University, the more lies on financial statements, the higher the chances that the economy is heading into a recession in the next 5 to 8 quarters. But how are you supposed to know when a company is lying? The study uses a metric called the Beneish M-score to determine the likelihood that a financial statement has been manipulated. The M-score analyzes sales, expenses, corporate debt, and the ratios between them to assign a score indicating the chances of accounting fraud. When developing the M-score, researchers analyzed data from thousands of publicly traded companies over the past 43 years, and found that the lower the combined M-score of these companies, the greater the likelihood of a recession occurring. The M-score is a statistical model that detects financial statement manipulation by companies. It involves calculating 8 financial ratios: Days Sales in Receivables Index, Gross Margin Index, Asset Quality Index, Sales Growth Index, Depreciation Index, Sales, General and Administrative Expenses Index, Leverage Index, and total accruals to total assets. Next, it standardizes the residual of these ratios. These standardized residuals are then squared, summed up, and compared to a threshold value, which sounds more complicated than it actually is. If the M-score is less than negative 1.78, the company is unlikely to be a manipulator. For example, an M-score with a value of negative 2.5 suggests a low likelihood of manipulation. If the M-score is greater than negative 1.78, the company is more likely to be a manipulator. An M-score of negative 1.5 suggests a high likelihood of manipulation. One study looked at using the Beneish M-score on Enron statements from 1996 to 2000 and found that as of 1998, the M-score would have been able to detect that Enron had significantly manipulated their accounting figures. But back to the first study. One of its authors, Professor Matthew Glendening from the University of Missouri, says that when companies misreport information, it can take years to be caught, and many are not caught at all. But accounting matters, and manipulated accounting information can have damaging consequences for the economy. Other firms and investors use this information to make employment and investment decisions, which can contribute to a ripple effect, leading to an economic slowdown. The M-score is a useful tool in detecting financial statement manipulation by companies, and could potentially serve as an early warning sign for an impending economic downturn. The study highlights the correlation between corporate dishonesty and recessions, showing that the higher the number of misleading reports filed by companies, the higher the chances of a recession in the next 5 to 8 quarters. By analyzing the M-scores of publicly traded companies, investors and firms can make more informed decisions and avoid potentially damaging consequences of manipulated financial information. However, the M-score should be used in conjunction with other methods of financial analysis and not solely relied upon as the final determining factor. For more investment tips, visit our website at claret.ca or get in touch with me directly by clicking on the links in the description. And don't forget to hit the subscribe button below.